Welcome back. Still watching the newsroom. Jiten Parmar is joining us now after a while. Jiten, good afternoon. Thank you so much for chatting with us. Last time we had you on the show, I remember you were talking about cyclicals and how you had gotten early into it. And in fact, stocks from the paper, from the real estate space, even metals for that matter, did rally quite nicely. I'll congratulate you on that call. Being someone who looks for value at a reasonable price in unloved areas of the market, lately in the last 6 to 8 months, which are those areas where you have hunted for value which were otherwise shunned by the markets?
Yeah, good afternoon. Good to be back on it now. So the sectors which we like currently, where we have made some bets, are capital goods, hotels, paper. Paper, we last talked about it, that was the early stage, so we have been investing over the last few months, or rather last 8 months in paper. So these are the sectors which we have invested of late.
Right. Jiten, I was just glancing through the work which you are doing as far as your research in your portfolio construction. I understand that you're playing capital goods space by some engine component companies. You're also playing manufacturing by auto ancillary. Talk to us what kind of growth which you see ahead. The cycle can favor these kind of areas. Your talks with the management or even listening to some of the analyst calls, what is the kind of strength you see? Is it more durable?
Yeah, so capital goods has been in a long down cycle, and that was primarily because of the economic slowdown we've had and the excesses in the previous cycle. So 7-8 years of downturn this sector has faced. Now what we are seeing since last budget, government has a massive thrust on infra, and that will percolate down to the economy. And we think that private capex is also starting. Talking to the managements of companies on con calls and so on, we have found that they are seeing increased inquiries and increased orders, and we are also looking at export plays in that sector, companies which have a significant export also, because countries abroad are also, or the economies abroad are bouncing faster. So currently, I think what we are seeing is that exports have been picking up, and there is a very good chance that domestic demand will also pick up.
So as we talk about this, domestic economy rebounding with gradual easing of restrictions and unlock happening, the one space which got badly bruised was the entire leisure, travel and the allied industries. These are smaller companies where balance sheet perhaps couldn't take the hit, and there was equal amount of damage seen in the stock prices as well. Have you looked at some of these areas, and does it merit an investment case looking in that direction? If yes,
Absolutely.
Where exactly?
Absolutely. So we have looked primarily at hotels to invest in this, because what has happened is this sector has been affected since the last more than a year of the pandemic. And if you see, a lot of these companies have put cost controls in place. Their cost to employee cost to hotel room has been coming down, and a lot of inventory, a lot of small hotels are closing down, and there are enough plays available in the hotel sector which have a very good balance sheet. Some are debt free and available at very good valuation. So we took a call in I think April and May to invest in this sector when the second wave was on. Obviously, we do track COVID, though I'm not an expert, but we have seen that waves, this moves in waves, and we were anticipating that this will come down. And if you see the revenge travel, if you may call it, hotels are booked across currently since mid of this month at least. And I think this sector will do well. We want to make sure that the hotels are strong financially with a good balance sheet, and I think these stocks will do very well.
Jiten, just to going back to our earlier discussion where you got in early areas, south-based realty companies, or even some of the ancillary companies for manufacturing, be it engine oil companies or refractory or input providers to metal cycle, or even paper for that matter, because they did rally reasonably. Are you still holding on to them, or have you booked out of that area? What's the argument from here on?
Yeah, so if you remember in our previous interviews, I had talked about early last year, we had talked about, metals and cement. And then in the September interview, we had talked about real estate and paper. So basically, our way of investing is contrarian, and we look for value. So some of these, for example, metals has been a fantastic, seen a fantastic run up. So metals, we would divide it into two, ferrous and non-ferrous. Ferrous is where, a lot of action has happened and a lot of, run up has happened. Non-ferrous also, some run up has happened, but as far as the cycle goes, we have a view of a longer term on the non-ferrous. Ferrous, we are not sure, how long this will last. So we are fully booked out of ferrous in the metals. And Midcap Cement is something which we had liked, and this continues to do well. We still see, at least 2-3 year cycle. So we will continue to hold on.
Then what are your thoughts on the sugar cycle? It is just going on full-blown rally in sugar names because of the ethanol story, and even the capital good providers to that cycle, all sorts of names from the small and large cap have rallied. What's your call there? And also an emerging sector which has really been down in the dumps is infrastructure companies, infrastructure stocks. For the last almost 8-9 years, nobody is talking about them. The likes of PNC Infra, so many KNR Construction, so many stocks have been buzzing last couple of days. No stock recommendation, but what are your thoughts on these two areas?
So infra, we continue to like. We have investments in that space, and we have gone with the better companies, and it has paid off quite well for us. We will continue to hold. I think there is a long runway for infra, so the better managed companies will do very well. As far as sugar goes, we took a call in February to invest into sugar. And actually, in the pure play sugar, we have booked out recently. It turned out to be very sweet in the short term, and we believe the risk reward might not be in favor currently. See, the ethanol story is there definitely. Sugar has become less cyclical. I will definitely agree to that. But the narrative that it is not cyclical may not be true, because what is happening is that sugar production is increasing, and some of it will be diverted to ethanol, but still there will be a huge surplus. So unless we see significant opportunity for export, and if you see, government has reduced export subsidy also, so we don't see a case for too much exports at the current prices. So we will be left with inventory. Yes, some of the companies are better managed, where a significant amount of revenue will come through ethanol, and they might be interesting to hold on to. But fresh capital allocation in sugar, we think the risk reward is not in favor. But yes, ethanol will continue. So we are playing it through companies, which will supply, capital goods to that sector, and there we remain positive.
Right. All right, Jiten, we'll let you go on that one. Thanks so much for sharing your thoughts and how you are approaching the market.